Thanks for staying with us. The SGX is indicating that we could be in for a muted start, but the big question is that should one really get carried away with this kind of a momentum, or it's time to take a very realistic call, assess risk, assess earnings, and talk about where valuations are. So what should one do in this market? If you're participating well, then the fundamentals are not favorable. If you're not participating well, then you're ignoring the momentum. So Dipan Mehta, this is a typical question where nothing looks good in the world, yet markets, they continue to climb the wall of worry. This time markets have managed to climb a mile long of worry. My question is, how long will this treacherous climb for the bulls continue?
I think you summed it up very well, and I was just echoing the same thought that typically bull markets, they do climb the wall of worry. And right now there are a lot of worries, but the market is just going higher and higher. Of course, there's a lot to do with liquidity in India, globally as well. But the best strategy is to focus on a bottom-up approach, good quality stocks which will survive recurrence, which will survive this pandemic, which will survive an economic slowdown which follows the reopening of the lockdown. Those should be in focus. At the same time, a rally like this is a good opportunity to get a little bit into cash. See, I see many portfolios and a lot of investors are more or less fully invested. But a rally like this gives an opportunity to go at least 5, 10, 15% into cash. So should there be any sharp correction or a sell-off, then you have some cash in the portfolio to sweep in and buy some of the genuinely good quality companies, which may then be available at attractive valuations. So right now, I think keep an eye on stocks which will survive and thrive in a post-COVID world. At the same time, try and increase the cash levels in your portfolio. We have seen such rallies and we have seen sell-offs also, and the opportunity will come to buy when there's a decline.
Well, I want to quote again what everybody wants to know in authoritative voice again on the vaccine, and that's Dr. Anthony Fauci. Anthony Fauci essentially is head of the infectious disease, and for those who follow global networks, they will recognize him that he's been warning about the spread of coronavirus right from April. Now on the vaccine, he says, coronavirus vaccine process is proceeding well. COVID vaccine probably will be available by year end or by 2021. Now he's not saying whether it will be mass available or not, but he's saying that, look guys, there are a lot of vaccine programs which are happening in the world and the vaccine is going to be available. So Dipan, is this the right way of looking at things, that look, this year will be a bad year, vaccine is coming through, and if you really take a bet on an airline stock or a company like Thomas Cook, or if you buy a hotel stock like Indian Hotels, you essentially are buying sectors where right now there is no visibility, there is zero business, but a year from now, 6 months from now, when you and me will start traveling, things will start becoming to normal. Is it like saying that 100 rupees ka maal 50 rupees mein mil raha hai, to put it in a very Dalal Street lingo?
I think 100 rupees ka maal 50 mein mil raha tha, but now it's more like 75, 80. So when you look at the risk return profile, it doesn't make sense to buy into some of these stocks which will be clearly impacted by the coronavirus. So I would say that it's better to go with some of the companies which will not get so much impacted by the coronavirus, the likes of, say, pharmaceutical companies, healthcare companies, to an extent non-discretionary FMCG companies. Then look at companies which benefit from a lot of consumers trying to make their homes more livable, so appliances, home improvement companies. And then on the look at the really beaten down stocks which really have a future once the economy returns to normalcy, and by that I mean the banks and FMCG, which are available at very attractive valuations if you exclude the top 2 or 3 firms or 4 firms in that particular sector. I think largely down the line, number 2, number 3 players, if you believe that they will survive and prosper in sometime in 21, 22, when the economy resumes normalcy, then those could in fact turn out to be good multi-baggers. So that's where I'm trying to kind of focus our attention and our portfolios, and not looking so much at where there is a high degree of uncertainty, like say the airlines or the hotels, or for that matter, the travel companies or even the exhibition companies. I think the time to sell those companies is gone because they have corrected the way they have, but it's not yet the time to buy. You prefer to buy when there is visibility and valuation in your favor. And right now, I think with the companies the sectors you just discussed just now, there is no visibility and there is no earnings or I would say margin of safety as well over there.
Well, if there's one space that the market has also been chasing along with pharmaceuticals, that's definitely been telecom. But you've got the AGR dues, still a big overhang, and the Supreme Court will be hearing that case today. Let's take it across to our colleague Abhimanyu, who's here to tell us exactly what to expect from the Supreme Court today.
Well, the last hearing in this case took place on the 18th of March when the top court had made scathing observations against telecom companies. The court had categorically said that no self-assessment of dues by telecom companies would be allowed. They will not hear any further objections. The court had made it clear that all dues have to be paid as per the October 24 judgment, including the interest and penalty, while the court had pulled up telecom companies for trying to influence the judicial process. Justice Arun Mishra, while hearing the case the last time, had observed that there were articles being published by telecom companies in various newspapers about possibility of reassessment of dues, which the court had categorically ruled out. However, it is possible that Centre's plea, along with plea by telecom companies seeking to independently negotiate the timeline and terms of payment of AGR dues along a long period of time would be taken up, although it seems unlikely that the apex court is going to cede any ground on that. However, Centre as well as telecom companies had cited the fragile health of the telecom sector in the previous hearings to put forth their point. It remains to be seen whether the same argument would be accepted by the top court or any leeway would be given as per the October 24 judgment.
Yeah, absolutely. Dipan, this has been an overhang and continues to be so, but the market is charting its own course, whether it be on Bharti or for that matter, even Idea, wherein there is the bigger overhang of the AGR dues. That stock has rallied like nothing. I mean, over 100% gain is what we've seen in just the last month altogether. It's now crossed from single digits or low single digits to now double digits. Where is the story head for Idea? And do you think the same rationale that you said earlier, it's time to take profits off the table, would imply even for an Idea, because you don't know which way this SC hearing could actually go?
See, the stock of Idea should be compared to that of an option, where whatever you buy, that is the maximum downside you will have. And if any positive event takes place, like today, if there is some relief on the AGR, or if a big investor comes in, and right now I think there's a great deal of fancy for big tech companies and large hedge funds to invest in India's telecom story. And those who may have missed out on Reliance Jio may look at Bharti and Vodafone as an entry point for whatever strategic interest or overall improved prospects. So from that point of view, Vodafone is an option. You have your cost built in the form of the stock price, and whatever upsides are there, those are all yours. And of course, a favorable AGR outcome will definitely benefit Vodafone far more than any of the other telecom stocks. Bharti, I think, is a more solid company, and serious long-term investors who are interested purely on the telecom play in India, and that's a bright story, are focusing on Bharti Airtel. And even at these levels, I wouldn't advocate at least booking profits in Bharti Airtel, but looking at increasing exposure at corrections. I think Bharti Airtel has what it takes to be a part of the core holding of every portfolio. And gradually, as the yields improve for the company and as pricing discipline returns, I think they will get a lot of benefit from operating leverages. Having said that, Bharti is a company in which we and our clients are invested. To that extent, our views may be a bit biased.
Okay, let's also go across to Avan for some of the other newsmakers that we're tracking this morning. Avan? Start off first up with Aurobindo Pharma. That's in the news this morning. They've got the US FDA approval for the injectable dexamethasone sodium phosphate. It is the 8th player to have got this approval, and the drug is essentially for anti-inflammatory medication. So watch out for this candidate. Its results all around then, Jindal Stainless rather. Well, it's been a mixed quarter. The profits are higher by about 43% and 94 crore rupees. Revenues are down nearly 14%, 2,030 crores versus 2,361 crore rupees. And the reported EBITDA too has suffered, so down nearly 20%. Though the management said that there are early signs of economic recovery and there hasn't been too much of an impact on account of the coronavirus. Shankara Buildcon has put out a fairly strong set of earnings. Margins have grown to 4.1% versus 2.6%. The profits is up nearly 3.7 times at 11 crores versus 3 crores. And revenue growth as well has been healthy at 667 crores, up about 12%. They're saying that they're looking to serve customers from the existing stock. They will be conserving their liquidity, and digital technologies and channels have become imperative at a time like this. MGL or Mahanagar Gas is on the brokerage radar. Credit Suisse has an outperform rating that they've maintained with a target price at 1,075. They're saying that Q4 was weak on account of volumes with low margin expansion due to the CNG volumes, but they have retained the benefit of the lower PMT gas price, and MGL has generated a healthy free cash flow. And finally, from the hospitality space, Indian Hotels delivered its earnings. Well, you had the profits come in at 76 crore rupees, so that's been low on a year-on-year basis. Revenue from operations has come in at about 1,063 crores, but they have opened 12 new hotels in the year gone by, signed 29 new hotels, and the margins at 19.6%. So we'll be watching out for all of these candidates, but let's also find out the top mid-cap strategies from our chartists. And Dr. Narayan, to you first.
Well, I'm recommending a long position in Ipca Laboratories. I think that's a stock which has been in the news with HCQ manufacturer, came to light after some time when this COVID thing ran on. The stock has not seen too much of a spurt, but has been very steady and has been respecting all support levels whenever it had suffered a small pullback. And even on the weekly charts, that continues to be so, all support levels sending stock prices up. Currently, over this week, I think the stock has managed to rev up and is signaling a fresh upside price action. So at the current levels around 1585.90, I would recommend a buy for a short-term investment with an expected target which should be in the region of 1625, 1675. Can maintain a stop loss of about 25 points from entry.
All right, Kunal, your top mid-cap pick?
Well, it will be a sell call, and it's a sell on Escorts. Now, the stock which did exceptionally well for a good part of the last 2-3 months, I think from 500 levels to almost 1,000 plus, which it tested a few days back. I think it's now showing signs of reversal. There's some indicators on the daily time frame charts, which indicate that the stock could probably have formed a short to medium term top at this 1,003 levels. So I think keeping that as a stop loss, I believe one could take opportunity of shorting the stock over here. Targets to be kept at 888, and stop us at 1,000 on Escorts.
Okay. Dipan, let's talk about some of those hotel stocks for a moment. We've got EIH actually delaying their results. Chalet, we saw a big revenue dip, and Indian Hotels as well. We are already seeing naturally the impact play out of COVID, only expected to get a little bit more severe going forward. Yet hotel stocks seem to be on every stalwarts list. What would be your strategy? I mean, would you look at a long term? Would you be brave enough and go ahead and take up some more of these names in your portfolio, and if so, which ones?
So we don't have any hotel stocks in our portfolio, and from that point of view, all hotel stocks are an avoid. There is one exception though, that is Mahindra Holidays, which is like a hotel stock, but it's more of a vacation ownership company. And that is, I said, available at extremely attractive valuations, way below its price to correct book value. And eventually, I think, as and when leisure travel picks up, and that will be the first to pick up, I think, rather than commercial travel, companies like Mahindra Holidays will certainly benefit. and it's a very valuable company in terms of whatever assets it's got into play, and absolutely completely debt free. In fact, there's opportunities to securitize the receivables on account of the vacation ownership which they have sold. At the same time, I think that times like this will provide them with opportunities to acquire more hotel rooms in vacation locations. So very positive on this company. Again, we and our clients are invested in it. Apart from that, I think all other hotel shares are an avoid for us. A great deal of uncertainty is playing out in the sector as a whole. Anyway, they were stressed out because of the likes of Airbnb. And now I think that with this particular COVID-19 situation, maybe the occupancies will remain low for an extended period of time. And these are very high operating leverage companies, which they work on very high fixed costs. And to that extent, the scope to reduce costs also is significantly lower. So it's best to avoid hotel shares, with the exception of the company I named, and look for some of other businesses which I think will benefit and continue to prosper even in the post-COVID world.
How about looking at Indian hotels or a Thomas Cook? I mean, the Indian hotels Dipan is backed by the Tatas. It's not going to go belly up. I'm keeping the last quarter numbers away and let's forget this year's numbers, but it's a company where survival will happen. Thomas Cook, promoted by Fairfax, net cash on the balance sheet. Pankaj and me were looking at numbers yesterday, 1,000 crore market cap, 500 crore cash, a great forex business. Would you be looking at buying anything on that front also? Like Mahindra Holidays is a great idea, but I'm just extending on your theme.
No, I think that Mahindra Holidays is a different space altogether. And the likes of Thomas Cook and Indian hotels are clearly to be avoided. Thomas Cook, in fact, has been a big disappointment in terms of whatever performance they were able to display, even when times were normal. It's a complicated company and the management is very focused on trying to do acquisitions, and then some of those don't really work out. They do not manage their capital efficiently, which is why explains the extremely low return on investment that Thomas Cook has. So I feel that it's best to avoid all these hotel and travel companies. One doesn't know how consumer behavior will be post-COVID, and what if there is a recurrence or there are still further risks of transmission that will immediately impact these hotel companies and these travel companies. So I would say it's best to avoid. You have a fabulous market, and frankly, one particular industry which has really opened up very well for investors is the pharmaceutical industry. And they are finding so many more ideas over there that investors should really have a look at their portfolio and see whether 15-20% of their portfolio is there in pharma stocks or not. So when you have such opportunities opening up for you, then why look at probable companies which may survive when normalcy returns? And even prior to this particular pandemic, it's not that the hotel shares and the likes of Thomas Cook were doing any great deal of outperformance or fantastic track record. I think last few years have been terrible for the sector as a whole. So I don't want to go for stocks which have been mediocre in the past, which have a great uncertain future, and buy them just because they are cheap. I would prefer to go for stocks which are cheap, where there is visibility of earnings and which may not get impacted if this particular coronavirus threat gets extended for many more months from here on as well. So that's my mindset from where I'm coming.
Okay. CK, where is Reliance headed? Simple. 100% is what Reliance has gained from the March lows. It has contributed 25% to the Nifty surge from the March lows. On a daily basis, you can be reasonably assured that Jio either has got fresh investments or they are talking to somebody or some deal is likely to materialize. Reliance CK has raised 1 lakh crore in last 3 months. 1 lakh crore. Best of the funds, best of the companies will be envious to hear that. But technically, where is the stock headed? I mean, we say CK in the market that buy on rumors and sell on news. But this is one stock which is moving higher irrespective of the rumor or the news.
Well, I guess you could say that is because the news has just kept flowing. We all heard of deal number 1 and then we said, oh, this is a damn good thing. And then even before that news cooled on came deal number 2, number 3, number 4, all in quick succession. Well, that certainly has shaken let's say, complacence of the market in taking a view that, okay, the rumor is now fructified into the news and we should sell. But then when you get back to back 3, 4, 5, 6 of them in a row, and then suddenly what Reliance had said long ago that we'll be debt free in about a year and a half, well, that's now becoming a reality, and it's actually getting advanced. So all sorts of revaluation are happening right now, but then they all need to get reflected in the price, right? And when you look at the price, 1600 levels has been a very definite resistance for Reliance, not once, but the stock has tested that level 4 times. Now 4 times spread across a pretty longish period of time of almost nearly a year or more. I think that is telling evidence that somebody sees Reliance to be overvalued at 1600. Now whether the news is good or bad or not, 1600 seems to be definitely attracting selling. Now, is the seller still having the quantity left, or are they still convinced in the light of whatever is the recent developments? I think we will know only when 1600 levels gets pierced decisively. Intraday poke about 1600 doesn't really count. But the stock is holding up rather well after hitting 1600, so it's not proved to be as decisive this time. So we may be, correct in concluding that this time around the sellers don't seem too convinced. So I would now be a buyer in Reliance only above 1600, 1610, rather than chance my arm at the current level of 1575 only to find out that the resistance at 1600 still works. I'm happy to let the 30 points go, but above 1600, it's all, blue skies then for Reliance. So I would rather play the blue sky scenario rather than take a risk at this level.
Fair point. That's the word coming in on Reliance Industries. But earlier yesterday, we also caught up with S. Narain. And here's what he has to say about his contra bets. He talks about pharmaceuticals, metals, as well as power being good bets in the long term.
See, there is a time to put in money, there is a time to take out money. The way we look at it is when ARPU growth slows down in telecom is the time to actually take out money from telecom. And you have to also look at it, there are sectors in the economy where you have had a 12-year down cycle. Take telecom, take power, take some of the metal sectors. You have had some 12-year down cycle. So, basically you can't have a 12-year down cycle and a 1-year up cycle. So that is also a challenge at this point of time which we are looking at. Can you have a 12-year down cycle and a 1-year up cycle? On the other hand, you can have a 12-year consumer, you can have a 12-year up cycle and a 3-month down cycle. This is the challenge at this point of time. I'm a believer you can't have a 12-year up cycle in consumer and have a 3-month down cycle, because after the 3-month down cycle, you're still trading in that sector at 60 to 70 times trailing PE. On the other hand, even today, the ARPU in telecom is just about $2.50 or $2 per month, which would be the lowest ARPU and it was ARPU maybe 10 years back. So I think there is scope for ARPU to go up in telecom. There is a scope for many of the sectors which got derated in the last 10
Well, pharma continues to be the darling of the market. In fact, today, later on in the show, we're going to be having Ravi Dharamshi as well, a pharma expert, and he will talk about where he finds opportunity in pharma even after the run-up that the sector has already seen. But earlier yesterday, we also got in touch with Sameer Beswala, Indian pharma and property analyst, and got his insights on where he finds value within pharma right now.
So, indeed, our virtual conference is going on pretty nicely. We are seeing a fair bit of interest, both from the corporate side as well as from the investor side. All sessions are going full. And you're right that pharma sector, after having had very tough last 4 to 5 years, finally in 2020 has made a good comeback. The sector in general is up 25-30% versus market being down 20%. So it's about 50% outperformance that we have seen so far. But Ajay, let me just take a step back to say that things which are going wrong last 3 to 4 years are the ones which are now completely going to reverse as we go forward. First of all is the earnings upcycle. And so we are going to see a multi-year earnings recovery. This is going to come on the back of recovery in the base business. B, some very nice, substantial product launches as we go forward. And the second point here is that the FDA scrutiny, which was, very tight last 3 to 4 years, is now getting much better for these companies, and more sites are getting cleared. And final thing is the starting point of valuation, which was at the beginning of the year quite good. So these are the factors which are going into play as the pharma sector, outperforms in the months ahead.
Okay, we're just counting down to the pre-open, so keep an eye on that. But I also want to bring up Shriram Transport Finance. I know we're not reading into the numbers, waiting to see how things pan out, but still, in the latest results, disbursements really badly affected. We've seen the numbers nosedive this time around. Dipan, you want to comment on that, Shriram Transport Finance? I'm just trying to see, what this is already indicating, given that while from some companies we're hearing end of May, they're starting to see green shoots, we could be far from it.
So I think that vehicle financiers like Shriram Transport and Chola and M&M Finance have been really impacted by what we are seeing on the ground level. But the stock prices have discounted a lot of those negatives. And end of the day, Shriram Transport and similar peer group companies are very strong. They are backed by strong promoters. They have a good track record and a very, I would say, strict underwriting policy as well. So eventually, I think that once normalcy returns, these companies will get back onto their growth path. The pre-provisioning profits are still holding up pretty well. It's just that they need to provide for NPAs, where also there's a great deal of uncertainty as to how much would actually turn back for these companies. So I would say that given the valuation of these companies which are trading at or perhaps below book value, if you have a longer term view and a contrarian mindset, then I think Shriram Transport, certainly you could have a look at it. As and when normalcy returns and overall auto sales pick up, then I think that the volume of business also will improve for Shriram Transport, and the NPA and the credit costs also will reduce. So from that point of view, I'm pretty positive on the NBFC space, especially vehicle finance companies. And there's scope for companies like Shriram who benefit also from financing second-hand vehicles. And from what we gather from the auto experts is that that's the market which is going to rev up pretty well and much earlier than the OEM. So very positive on Shriram Transport, but you have to have a longer term view over there.
All right. Well, everyone's taking the brunt of what we're going through currently. On a lighter note, we had an exclusive conversation with Mark Cuban just a few weeks ago, Nikunj and I, and we asked him if he had to go back to basics and start from scratch, what would the 24-year-old Mark Cuban do today? What would be his advice? Listen in.
Starting all over again. If I was broke, just